If you're watching this video, you've probably invested in stocks and bonds, but you may not fully understand the way the markets work when we're buying a stock or when we're buying a bond. In today's video, in a few minutes, I'm going to talk big picture how the markets work when we are being an owner and buying stocks or a loaner or buying bonds. And then I'm going to give you a specific example with a specific stock we all know so you can say, how exactly can I determine how to make the best decisions when deciding if I want to buy ownership in a company and a stock or to lend to that company? Okay, let's get started. So when we're investing our capital, in the center, there's always a company. So let's look at this chart here. This is a company that needs to raise financial capital. So they need money. This could be any company that you're thinking of. So there's the company in the middle, and then there are investors on the sides. Now we have two choices on how we want to interact with that company and how we want to allocate our capital. We can invest in bonds, and we can lend money to that company, or we can invest in stocks. And when we invest money in stocks, rather than lending and getting interest, we're actually getting an ownership share in that stock. And so going over to the bond side, what this is a contractual obligation from the company to give us a stated interest rate for a stated period of time, and then we get our money back. So that's a bond. Versus a stock is very different. There's no guarantee when you buy an ownership stake of a company that you're going to make money, right? It's not stated, it's not implied. When you buy an ownership share of a company, what it says is you buy a piece of this company. If it makes money, you make money. If it loses money, you lose money. And so when you become an owner versus a loaner, these are two different ways to allocate capital. And so again, there's the company in the middle and they say, hey, we need to raise funds. We can either issue bonds and start paying out interest, or we can issue ownership shares and have more people be invested in the future direction of this company. Okay, so that's big picture. You can be an owner, you can be a loaner. You can buy stocks, you can buy bonds. Very different ways to allocate your capital. So how can we determine what's right for you? What's right for your portfolio? Well, let's use a specific example. So rather than this just box in the middle that says company, let's use a company we all know. Let's use Apple. Okay, Apple makes iPhones, they have a cloud, they make laptops. We all know what Apple does. Well, if we have money to allocate and we're looking at Apple, we have a couple of choices. We can choose to buy Apple bonds, which means we are lending money to Apple. They're going to give us a rate of return, a fixed interest back, and then at some point in the future, based on how long our bond is, we get our money back as long as Apple stays in business. And currently, again, this is early 2025, interest rates on Apple bonds are around 5.5%. So if you buy a 20-year bond with Apple, they're going to give you a 5.5% interest rate for as long as you own the bond. And then at the end of that period, if you hold it the entire period, you get your money back. Okay, great. You lended money to Apple, they gave you an interest, and then you got your money back. It's around 5.5%. It's a little higher than if you just put your money in treasuries, which are around 4%, which you would expect. Okay. What if we go over what does it mean to be an owner in Apple? Well, we put money in Apple and we say we want ownership shares, which means we want our share of profits and losses. Well, Apple's obviously has plenty of profits. They're one of the most valuable companies in the world. But when we become an owner, one of the important things that we need to be looking at is what is the price that we are paying for this ownership share? Is it expensive? Is it cheap? And one metric that you can look at that's readily available is what's called the price to earnings ratio, which means for every dollar in earnings a company has, how much are we willing to pay for that dollar in earnings? And Apple's price to earnings ratio, depending on if you're looking at forward earnings or trailing earnings, and we've talked about those terms in the past, but to make it pretty simple, the current price to earnings ratio of Apple is right around 30, okay? What that means is for every dollar of Apple's earnings, we are paying $30 for that share of that dollar. So 30 for one. Said another way, Apple could give us all of their earnings for 30 years, and that's how long it would take for you to get your money back, 30 years. You say, okay, that's one way to think about it. Is that high or low? Well, historically, Apple trades at a much lower price to earnings ratio than 30, so it is expensive. And so why would anybody buy an ownership stake at this high price? Well, because the story that we're telling, or the story they're telling themselves about the future, is that Apple's earnings are going to go up. And they're going to go up a lot. And they're going to go up way more than the market. So therefore, that ownership share is going to be really valuable. And so, is that right? Is that wrong? The future is unknown. But as an investor, we should be able to look at companies, look at indexes, and just look at investments in general and say, okay, I can be a loaner, which means bonds. I can be an owner, which means stocks. And with bonds, it's a little clearer. Okay, how much interest are you going to give me? What's the risk-free rate with government bonds? What's the difference? Is it worth it for me to take the risk of that company? When it comes to stocks, how much am I paying for every dollar in earnings? And what is the story that I'm telling on the reason that I'm willing to pay for that dollar in earnings? And so this is just a high-level overview of how the market works. Be an owner, be a loaner. As I always say, know what you own and know why you own it. I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.